We're here today to cover capital markets, debt and equity, industrial, office, leasing, sales, pretty much the full gamut of real estate activities. We have Val Achtemeier, Kevin, Shannon, and Darla Longo from CBRE. Each one has a particular area of expertise and then sort of a general real estate knowledge of all the other products and markets and transaction types. We're going to start off with Kevin, asking him to give us an overview of the investment sales activity right now up and down the West Coast.
Right now, the market for office investments is firing on all cylinders, Tony. The capital market gods are smiling on us. The debt market is very competitive and it's helping the secondary product especially. The core environment right now is terrific. We're making records in markets like Seattle and Denver and Los Angeles. There's a definite lack of product for the most part up and down the coast, but we're starting to see more guys coming off the shelf as we see these favorable comps. Guys are starting to look at taking stuff off the shelves. But we're in a great environment. We've got too much debt, too much equity if you're a seller, a lot of foreign capital. The optimism in the underwriting is great. So, I mean, right now the capital market environment is very good.
Great. Val, give us an update on equity and debt, in particular debt.
It's a very positive time in the debt markets as well. We're seeing a lot of liquidity across the board, really with a wide array of products available from lenders. We're also seeing very competitive pricing. There was a lot of discussion last summer about the interest rates rising and Treasury impacts, and certainly rates are a little higher than they were last summer, but we've seen some further compression in spreads, and I think the market has gotten used to our new normal here that are still very attractive rates. We're also seeing banks step up to the plate and use their balance sheet a lot more and more effectively, both for stabilized assets and more for transitional assets. So we're seeing capital available really across the capital stack at competitive pricing. So it's a good time. It's a very, very good time to be a borrower right now.
Great. Darla, give us some info on what you see happening right now in the industrial markets in particular.
Yeah, I mean, I echo what Kevin shared about the dynamics of what's going on in the overall market. Industrial is kind of the new darling in terms of where capital wants to flock. I think multifamily was kind of the darling previously, and now industrial really is where capital wants to buy. We're seeing a huge increase in foreign capital, which is unusual, buying industrial. We have we have a huge portfolio that we're out with right now, and we've got Korean and Chinese capital coming into the market, which we have seen in the past, but now it's a little bit more prevalent than it was in the past. The dynamics and the fundamentals of the market up and down the coast have grown exponentially. The big box market came back. Now the smaller tenant is coming back. So overall, everywhere in the western U.S. we're hitting on all cylinders for good market fundamentals, and industrial is the new darling for the capital markets.
Great. So Kevin, when the capital markets came back, investment sales markets came back, and the stuff that you tend to work on, most of it was well-released, core plus. Now people are looking at some deals with vacancy. They're looking at land deals. They're looking at rehab deals. There's still a lot of people chasing the core and core plus. What's the differential sort of, generally in sort of cap rate analysis on those deals?
What you're describing is typical for every cycle. Capital's moving up the risk spectrum as we get deeper into the recovery. So you are seeing guys taking on vacancy. You are seeing in some of the best markets in the coastal markets spec construction. And so, the cap rates are going to differ. What we have seen on the core side is we've seen capital reach sub-6 on the unlevered IRR. That used to be unique to Manhattan and a market like that. On the West Coast, we hadn't really seen that. We're starting to see that, where people are going sub-6. That is causing guys to relook at their strategies and go, maybe I'm better off building to core. There wasn't a lot of building in the last cycle, and guys are looking at some of the healthier markets like San Francisco, Seattle, core submarkets like Playa Vista, Hollywood, and LA, Pasadena, and saying maybe I'm better off building to core. And because if you have a core deal, you don't really want to sell it. because you have no place to put the money. So we're clearly seeing a lot more strategies involved with building decor, and I think the spread between a core deal and building decor might be 200 basis points. But we're also seeing people play in between. You know, on the value add deals, we had a value add deal in Phoenix where we had 24 tours on a vacant building in Kierland. We had a deal that just closed this month in Pasadena where we had over 40 offers. So for a well-located core deal, especially a Class A core deal, value add deal, there's a lot of capital chasing that. So there really isn't a shortage of capital in any of the food groups right now, although suburban office still remains the lightest, although clearly there's more strategies for suburban office in 2014 as people look for yield. They're having trouble getting it clearly on the core deals.
So it used to be that when the price per pound went past replacement cost, it was time to build. Is that a little bit of what you're saying about these cap rates compressing and the?
Absolutely. The other thing we're seeing is these new buildings are trading substantially above replacement cost. Right now, this month in Denver, you're going to see an all-time high over $600 a foot. In Lodo, you've got a deal under contract in Phoenix at over $400 a foot, which will be an all-time high for Phoenix. We've got a deal that we just closed in Seattle, which was an all-time high for Seattle this month. Same thing's happening in LA and Century City. So when people look at these prices above replacement cost, you know, building to core and building a new spec building is an attractive alternative. Guys like Kilroy saw that 2 years ago and have used that strategy very effectively.
Yeah, there's nobody left that wishes they hadn't bought as much land as they bought.
Yeah, I mean, the first guys in always do the best. If you look at downtown San Francisco, I think you got 3.6 million square feet under construction, and that product right now is probably about 75% leased. So, I mean, it was a great strategy for the guys that get in early. In other markets like Seattle and Los Angeles, they're not as far along as San Francisco is, but the same strategy is being employed.
Okay, so Val, you're in the position of helping put the debt on all these deals, especially you work with Kevin a lot with his sellers or buyers and identifying debt opportunities. And there's a lot of players. What's the difference in the underwriting or the terms and conditions of the debt that won't make us feel squeamish that we're going to repeat 2004 through 2007? Although we had a really good time during those years, we didn't like 08, 09, and 2010.
Well, I think it's a somewhat complex answer, but we're seeing more players move up the risk spectrum, but I think they're doing it in a more disciplined manner than they were in 2007. They're really getting an understanding of the submarket, the property, the risk profile, and I think they're doing reasonable loan to value. So I think in 2007 there was a sense that people were just sending term sheets out in 24 hours to win the deal. I think people are being disciplined and making sure they know the project and know the market well enough. But we are seeing, you know, higher leverage loans available, more mezz money available. You mentioned construction loans. That's something that's emerging right now and moving very rapidly. So I think it's overall still at a healthy state, and it's good. You've got more and more players, but there's discipline this time around, and I don't think it's gotten out of control. Something we're all going to watch, right? But
the underwriting is better.
The underwriting is better.
The product they're willing to attach it to and the sponsorship is
correct.
Different. It's not. Everybody can't get 90% on everything at
right.
all times.
Most of these core deals, there's no debt involved.
Right.
They're all cash.
So they're all cash.
A lot of REITs and
Yeah,
foreign
yes.
buyers.
Yeah.
And
So you don't have one of the biggest problems of 06, 07 was the LTV and the uber leverage that buyers are using. That's not happening this cycle so far.
Right. I agree.
Darla, we've spoken a lot before about the fact that the industrial, both the leasing and the investment sales activity was driven by e-commerce. Is that still happening? Is it different now in a better way or not? What's your theory on that?
Well, the e-commerce sector has grown kind of exponentially in the industrial area this last year. Amazon, with the building of many of their facilities across the country, has really kind of been the leader of the pack with e-commerce. But I think we've kind of come up with and actually are working on a white paper of what's the impact of e-commerce is on the smaller companies, because we're going to call it priority proximity, because when you look at FedEx and UPS Ground in Southern California alone, they're looking for 10 to 12 new locations, and companies are using Amazon, Google, you've got Walmart.com as an engine to move their product. And so where a company wants to have priority shipping, they're going to locate in a facility close to population centers and close to FedEx and UPS ground. In the next 3 years, we're going to see a shift where capital is going to recognize this new pendulum of e-commerce located to population and around FedEx and UPS ground. And we believe the rents in those buildings, even if they're 24-foot clear, low clear, are going to command higher rents because companies that use the Amazon engine as an example as their internet-based company are going to need to be next day, same day delivery close to those population centers. And I think if you look at whether it be light product, heavy product, even though Amazon is taking a lot of that in-house, I think there's going to continue to be a lot of those companies that are going to need to locate around those hubs.
Are the e-commerce driven tenancies in these warehouses priced on a cap rate basis similar to sort of traditional warehouse users that used to be at the highest end when you had a cap rate analysis?
Well, what's been different about just using the Amazon warehouses as an example, because we have sold 12 or 14 of them across the country, is that capital is looking at those as credit, state-of-the-art facilities, and some in secondary, tertiary markets, and Val can comment because she did do financing on those. But what we are finding is capital will capitalize not only just the base rent, but the above standard TIs into the overall lease. And in particular, if it is if it's a 15 to 20-year lease.
So because it has reusability and it's making the product state-of-the-art for a significant amount of years and
well, I
have
don't
a
know
much better
necessarily
exit strategy or not?
Yeah, I'm not so sure if the reusability of the TIs are necessarily going to be a factor, but I think that capital's recognized that the excess land, the state-of-the-art building, and some of the features of the building are reusable, but most of it is really taking the mechanics of an internal material handling system and building a box around it. And
they just have more confidence that that'll have longevity and pay the rent.
Yes.
Okay. So on the debt side, and what's interesting is we have the industrial market being driven by e-commerce, and we have a lot of the office market being driven by internet-related companies really on the social media side. So Val, give us a little bit on underwriting, in particular for debt, on a, 5-10 years ago, if Amazon had a warehouse, that wasn't that great of a deal for debt. Now it is. How does that compare on the underwriting for debt basis? And we'll go to social media in a second.
Well, one of the things that we're seeing on the debt side is that a lot of our clients want to have some optionality and flexibility. Gone are the days where someone's going to own an asset for 15 years of your fund or something. So Darla and I just worked on a project. We closed it this week. She sold a large portfolio for one of our clients, KTR, and then we went ahead and put a $142 million loan on it, but it's a national industrial portfolio. And we did a combination of fixed and floating. So we locked up 65% of those proceeds at a very attractive low rate, and then we went floating with 35%. That gives the client the optionality to sell some buildings, to move some assets in and out. Gives you a really good blended rate. I think we're at a 2.6, 2.7% blended rate today for 5 years. So that's one of the things you do with industrial assets sometimes is you put them together in a portfolio, and I think you get better execution and better pricing. But if the client doesn't want to do that, single tenant deals with strong investment grade credit, such as a FedEx or an Amazon, we're doing a lot of those types of financings too. You just need to look at the dark value, the location, where it's at. Interest only tends to be pretty important for a lot of clients that buy single tenant deals, and that's available today. We've done a number of Amazon financings, and you just need to kind of work out what the best strategy is in terms of how long do they want to finance, do they want to fix or float. But there's a lot of money available for those things.
So the financing market, though, is recognizing them as credit tenants also.
Absolutely.
We all forgot about what happened in 2001 because the lenders are too young to remember any of that,
right.
Which is good. So Kevin, you sell a lot in Seattle, South Lake Union, Bellevue. Your broader team, and you assist them, sells a lot in San Francisco and south of Market, the Silicon Valley. A lot of that is driven by the social media tenants. And we love everything that's going on. Is there a is it what's your view on it someday that isn't kind of what you want to buy anymore, or you don't see that signaling yet?
You know, it's right now the fundamentals in those markets look great.
Right.
It's all systems go, but they've been doing this for a while, and their recovery is far more mature than markets like Orange County or Los Angeles or Phoenix. There is capital that thinks those markets are in the later innings, you know, 6th, 7th inning.
South Lake Union, Bellevue, Somar,
You know,
those 7th, 8th?
is Amazon going to slow down? I don't think so.
Right.
I think that's going to keep going. I think Seattle's got some terrific engines besides Amazon as well. I'm looking at, I'm hearing Boston Properties is going to do a major pre-lease on Transbay. I mean, there's nothing that I'm seeing that's indicate anything slowing down. Things continue to get better. If you were to forecast what the next year would look like in those markets, I think it's going to look better. But there's a lot of capital, though, that's uncomfortable with maybe the price per square foot and the low metrics. I mean, the underwriting for value add deals there is priced to perfection. There's more, I think, you know, you're seeing, like in Orange County, you've seen recently in the last 6 months, Blackstone, CIM, Starwood, CBRE Investors, Hines, Oaktree make some major bets, and that's smart capital. And so I think, you know, a market like that's interesting because you're so far below peak pricing still. You're still in the 200s, whereas peak pricing, you know, reached 500, you know, 480, you know, and so markets like Phoenix, I mean, Phoenix and Orange County are two of your top 12 markets for absorption, you know, since 2010, but the rents haven't moved, and they're building a base, and the discount to replacement cost, the discount to peak pricing's there. So you're seeing smart buyers go there.
But those are mostly people that can spread the risk if there is any across a lot of portfolio, like a Blackstone or somebody.
Yeah, and we saw CIM buy 2Cal, and 2Cal, what a great basis play. I mean, you're in the building at $225 a foot approximately. It's a great basis play. You look at the Brookfield basis and your primary competitor's basis, and you've got the lowest basis in town in the trophies. So there's some interesting plays out there in contrarian markets that haven't turned as much as Seattle and San Francisco.
Okay. Darla, tell us about this interesting deal you just did in Seattle.
Yeah, very interesting deal, that a 2.8 million square foot industrial park that we sold to KTR, really a value add opportunity. What was interesting is that B class assets in an A market, we sold it for $170 million, and what I think, flashing forward from the time it closed to today, the leasing activity has picked up exponentially, and it's turned out to be a great investment for KTR. And we're finding much more capital kind of circling around in that market, an example of B product in a Class A core market. So excellent transaction for KTR, and currently they're looking to buy more around that area, as are many other capital sources today.
Great. Val, we were talking about core debt deals a little earlier. Tell us about the one you did in Playa.
Yeah, that's a good example. I mean, we're seeing a lot of the core buyers, in this case it was Hines, but just look for moderate loan to value, kind of in the 50 to 60% range. And they're also considering floating rate money for core deals, which we used to always think they would only do 10-year debt. In that case, we went with MetLife as a lender and got a very attractive rate, around 150 over LIBOR, 5 years full IO, and a moderate loan to value. But it was a really fast transaction that met everybody's needs.
Right. Okay. Well, thank you. It's been very informative. I
Thank you.
appreciate all of your commentary.
Thank you.